The risks faced by ordinary working people have to be a key consideration for any social security system. Risks matter, and most ordinary people cannot carry much investment risk anywhere in the world. The CPF does not provide the highest returns in the world, but it provides fair returns and is certainly one of the safest for members. Few systems offer the guaranteed floors on interest rates that we do. In effect, a 3.5% floor for the OA, the ordinary account, and currently 5% on the SMRA accounts for the majority of members, and up to 1% less than that for those with larger balances. I agree that we should study how to provide better options for members who are able to take on more risks so that they can try and earn higher returns. Better options than are currently provided for under the CPFIS system. Several speakers today have mentioned ideas for how we can go about this. I think this should be studied. We previously looked at this, how we can enable members to use their CPF savings to invest in private pension plans, and it remains an option for the future. In 2000, when we last reviewed this, 2007, when we last reviewed this, we decided not to go ahead as yet. This was because most members had low balances and could not absorb investment risks. Our main focus then was on the majority of members. We wanted to introduce good, sustainable interest rates on the SMRA and OA accounts and provide extra interest to help those who did not have large balances. That was our priority at the time. So we left aside the issue of private pension plans. However, we have to study any new options carefully, take in views, and ensure that everyone understands the risks. Private pension plans will not be a walk in the park. In principle, you should expect to earn a higher return over the long term by investing more in riskier plans, by being more exposed to higher risk assets. In principle, you should expect higher risks over the long term, higher risks and higher returns over the long term. But in practice, you can go through long periods, 5 years or even 10 or 15 years, without seeing higher returns. The investment markets move in cycles, and the cycles are often long. So it's not just occasional bouts of volatility, but they're also long cycles where investment returns do not materialize as expected in theory. The experience of Hong Kong's Mandatory Provident Fund Scheme, the MPF, is illustrative. It is effectively a scheme where members choose a private pension plan. You're mandated to save, and you have to choose a pension plan. And you can take more risk in the hope of higher returns. Since its inception at the end of year 2000, the MPF in total has had a rate of 4% in nominal Hong Kong dollars. That is in fact about the same as what CPF monies in aggregate have earned in Singapore over that period, and lower than what was earned on our SMRA monies, special account, retirement account, MediSave, in Singapore dollars. And bear in mind that the Singapore dollar has strengthened significantly over the time compared to the Hong Kong dollar and many foreign currencies, which means the same foreign currency returns translate into less in Singapore dollar terms. So the fact that we have earned more on the SMRA than Hong Kong's 4% in Hong Kong dollar terms actually means more than it appears at a glance. And that's without taking risk. Even for the more aggressive funds that are available in the Hong Kong MPF system, the Hong Kong MPF Equity Fund, it's earned 4.5% over that period. Higher risks, but not higher returns than our guaranteed rates. It doesn't mean these are ill-conceived funds. In principle, in the long term, you can expect to earn higher returns for higher risks. But you can go through long periods where higher returns do not materialize. That's the basic lesson from evidence. That's the basic lesson from experience. It's not that they're ill-conceived, but we must understand the risks, and only those who are able to take the risks and have their eyes wide open should take such options. And what of the future? Investment professionals know that the global market environment has changed. Low bond yields, ultra low bond yields, and weaker economic growth prospects in most of the advanced countries have made it very challenging for funds with traditional balanced portfolios. The traditional portfolios of pension funds are facing increasing challenge. Some have already recognized it, others have yet to recognize it. For example, a simple 60-40 global fund, which means 60% in global equities, 40% in global bonds, is now estimated to be able to earn about 4% per year in nominal US dollar terms over the next 10 years. That's an estimate by one major fund management firm. Other estimates vary around it, but even if you add 1 or 2 percentage points to it, that's in nominal US dollar terms, and it tells you how much the investment environment has changed. It's changed quite fundamentally. Not forever, but for the foreseeable future. And that's before conversion into Singapore dollars. So the main challenge will be for private pension plans to offer a realistic chance of achieving better returns than the CPF special account scheme. They have to compete with a guaranteed 4 to 5% interest rate that the special account offers, and which you can use your ordinary account monies to benefit from as well by shifting it to the special account. That's tough competition because we raised our interest rates. It is difficult for private plans to compete. But let's study this. We have an open mind, and we certainly have no reason in government to not want such funds to take off. Let's study what is possible. And in the long term, I believe the CPF system will do well by having more choice for members who are able to absorb more risks.